So Bank of Japan announced to hike its interest rate and reduce its bond purchases. Microsoft earnings failed to please its investors. AMD gave hope. Meta, Apple, and Amazon are due to announce their own quarterly earnings in the coming hours and in the coming days. And the US Federal Reserve will reveal its latest monetary policy verdict a bit later today. So, welcome to another episode packed with data and news. This is Swissquote's Daily Market Talk. So we have two important headlines this morning: the Bank of Japan decision and Microsoft earnings, and I will start with the BOJ decision. So the Bank of Japan went ahead and raised its interest rates to 0.25% as cautiously expected by analysts, and it also announced that it will reduce the monthly bond purchases in a predictable manner, but they will still allow enough flexibility to support stability in the JGB markets. More importantly, guys, the language from the BOJ's communique was quite bullish on prices, as they said that underlying CPI inflation is expected to increase gradually, since it is projected that the output gap will improve and that the medium to long-term inflation expectations for Japan will rise, with a virtuous cycle between wages and prices continuing to intensify. And that really sounded hawkish and hinted that today's interest rate hike from the BOJ is certainly not its last one. Now, all eyes are on the Bank of Japan Governor Ueda for further tips and hints. He hasn't spoken just yet at the time I'm talking here, and this episode will be published before he does, unfortunately. But the 10-year JGB yield is pushing higher this morning after the BOJ decision, and the Japanese yen is in demand. Both the dollar yen and the euro yen tested their 200-day moving average levels to the downside, and the sterling yen extends and consolidates losses below the 200 psychological mark after the decision. And there is reason to believe, with what we heard so far from the Bank of Japan, that the monetary policy in Japan will become less loose in the coming quarters to support the Japanese yen in the medium to long run. So that's one key takeaway from today's Bank of Japan decision. But again, I haven't heard Mr. Ueda speak just yet, and that could just change the market sentiment a little bit. But overall, the BOJ is normalizing. Now, across the Pacific Ocean, the Fed also started its two-day monetary policy meeting yesterday and will announce its latest monetary policy decision later today. The Fed is not expected to make any change to its interest rate today, but is widely expected to hint at a September interest rate cut. Now, activity on Fed funds futures doesn't only hint at a 100% chance for an interest rate cut to happen in September, but it also shows that the Fed, those are getting a bit ahead of themselves really, and are actually assessing a nearly 15% chance that the Fed could cut 50 basis points or more, which will obviously not happen unless there is a big crisis or big stress on the financial markets. So, to me, this overstretched pricing regarding the Fed is a sign that the Fed cut pricing went too far at the point we are right now, and that we shall see a correction, even though the Federal Reserve hints strongly at a September rate cut at today's decision, with the risk of obviously hardly upsetting the market if it does not. So the US 2-year yield remains on track for further weakness in the base case scenario of a hint for a September rate cut from the Fed, while the US 10-year yield consolidates near the 4.13% mark this morning. The US dollar index is softer this morning, but the index remains in the bullish trend, mind you, above a major Fibonacci support to its year-to-date positive trend, as the rate cut bets elsewhere rise along with the Federal Reserve's rate cut bets. In this context, the euro-dollar tipped a toe below the 108 psychological level yesterday after a surprise slowdown in the German growth numbers that actually cast a shadow on a better than expected Eurozone GDP number. Otherwise, inflation figures, on the other hand, were encouraging in Spain and not so much in Germany. So the aggregate Eurozone inflation figures are due later this morning. A sufficiently soft set of data should keep the ECB those in charge of the market and not let the euro-dollar gain too much strength in case we see a rebound after the Federal Reserve decision later today. Yet note that while the US long-term sovereign bonds and the US dollar also benefited from some safe haven demand yesterday after an explosion in Beirut that actually followed a Hezbollah attack on Israel during the weekend. Remember, escalate the geopolitical tensions in the Middle East, unfortunately, and directs some capital toward safe haven assets. And in this context, we also see gold extend its gains above the $2,400 level and the franc advance as well. So zooming in the Swiss franc, the dollar franc is no longer on track to extend its year-to-date gains. On the contrary, the pair has now slipped below a key Fibonacci support level. Back in mid-July, the major 38.2% Fibonacci retracement that actually stands near 0.8885 level and is now in the bearish consolidation zone. So the tense geopolitical setup in the world and softening Fed expectations kind of explain the U-turn that we saw in the dollar franc. However, the global easing vibes for the major central banks will certainly encourage more interest rate cuts from the Swiss National Bank this year, and that should eventually limit the downside potential in the dollar franc or the upside potential of the Swiss franc. Elsewhere, this Beirut explosion, a swift flight to safety as a result of it, and a renewed sell-off across the big technology stocks in the US weighed on major US indices at yesterday's trading session. The S&P 500 fell 0.50%, while Nasdaq 100 slid around 1.40% yesterday. Nvidia tumbled 7% to its 100-day moving average, but Nasdaq futures are in a better shape this morning at the time I'm talking here, following a 7.5% rally from AMD after raising its forecast for AI accelerators. Microsoft, on the other hand, didn't really blow investors' mind yesterday when it reported its earnings. I mean, the overall revenue for Microsoft rose by a slightly better than expected 15%, which is not bad, but revenue from Azure, its cloud computing platform, that's the main growth engine, grew only 29%, so that's down from 31% growth that was reported in the previous period. And about 8 percentage points of that increase was due to AI, reportedly up from 7 percentage points, but it was not enough for investors. The market first sent Microsoft shares 9% down in the after-hours trading, and the price then recovered to settle with around 3% loss. So due today, after the bell, Meta's results will be very important for those looking for hints and tips that all that massive AI spending from big tech names is bearing fruit. Meta had said last quarter, remember, that it needed to spend more on AI to get to a level of play that will eventually generate revenue. Now, hopefully, that timeline to generate revenue doesn't extend at this quarter's announcement. Mark Zuckerberg actually knows, he understands very well that investors' patience is wearing thin as Meta trades some 15% below its July peak. Last but not least, crude oil tumbled to $75 per barrel level at yesterday's trading session, unable to recover from the negativeness of the sluggish Chinese growth, but the rising geopolitical tensions in the Middle East and a major decline of nearly 4.5 million barrels in the US oil inventories last week are actually helping to bring some dip buyers in the market near the $75 per barrel psychological support. So I believe that we may have hit a bottom near the $75 per barrel level this week. And I also believe that the lower the oil prices will go, the higher the chance of a delay from OPEC to exit its production cut strategy. So this is all for today, and this is all for this short week for me, as I'll be off to my 2-week summer break from tomorrow, and I will be back in 2 weeks from now to comment and to analyze the market moves as usual. But before I go, I would like to thank you all who stick with me every day to follow and to discuss the latest market news. I thank you for your insightful comments. I thank you for being here, and I thank you for your interaction that makes this space a beautiful platform for discussion. So please keep doing so. Please continue to leave your comments, continue to leave your reactions and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates, and also subscribe to our YouTube channel for daily market comments if you haven't done so far. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again in 2 weeks, and until then, good luck trading.